Good afternoon, folks. Welcome to the Liberty Call for Tuesday, April 12th, 2022. I hope everybody's having a fantastic day out there in the interwebs. It's starting to turn out to be a pretty good day here in Colorado. It was kind of cloudy and drizzly all morning, but the sun has come out. We are due for another snowstorm sometime tomorrow, so yay. It'll melt fast, but it's still aggravating to have to deal with snow in mid-April. So, all right, kind of a back and forth day in the markets. The futures overnight looked like we were headed towards a down morning, and woke up to the market was in the green and was looking pretty good. And by noon, it had kind of fallen apart by the end of the day. So let's go ahead and take a peek and see how things did across the markets today. The Dow Jones finished down 0.26 at 34,220. SP 500 down 0.34 at 43.97. NASDAQ was down 0.3 at 13,371. Small caps were slightly up at 0.32. The VIX receded today, down 0.45 to 2426. Let's see. Canada was down 0.34. Brazil down 0.69, Mexico down 1.02. Moving over to Western Europe, Germany was down 0.5%. Same with the UK. France was down 0.25%. The Euro Stoxx was down 0.21. One up market, looks like the Netherlands was up 0.23. More downs. This is Portugal, Italy, Switzerland, Portugal. What was this one? Oh, that was Spain. I'm sorry. Belgium, all down, ranging from 0.08 to the worst at 1.2. Got two up markets here. This is Austria and Sweden, up 0.24 and 0.21. Another rash of downs. Let's see. This is Denmark. Both Russian markets were down. Poland and Hungary. Moving over towards the Asian markets, Turkey was up 0.6. Israel was flat. Saudi Arabia was up 1.21. Japan down 1.81. Australia down 0.42. New Zealand down 0.87. Looks like all the Chinese markets were up. The Shanghai was up 1.46. The SDSE component was up 2.05. China A50 up 2.23. DJ Shanghai up 1.52. And the Hang Seng was up 0.52. And the Taiwan weighted was down 0.34. And it looks like all the rest of these were just kind of a smattering of reds and greens. So across the day for trading day, April 12th, looks like things started out pretty good in the Asian markets. And then by the time we got to Western Europe, lots of red. And then, like I said, we started out in the green most of the day and then fell back into negative territory. All right, so let's take a peek at some of the articles for today. First one is just a recap of the market. Stock market today, Dow slips as tech rebound fades ahead of bank earnings. The Dow reversed gains to close lower Tuesday as tech's attempt to rebound. That doesn't even make sense. As tech's attempt to rebound failed. Does the computer write this? Following data that fueled debate on whether inflation was nearing a peak. The Consumer Price Index, or CPI, climbed to 8.5% in the 12 months through March, above economists' forecasts of 8.4. Wow, it was off by 10 basis points. But it was the core CPI, which excludes food and energy, that dominated investor attention. Core CPI rose 0.3% in March, slower than economists' forecast for a rise of 0.5%, led by a larger than expected decline in core goods prices, alongside a surprising miss in rents, in quote, Morgan Stanley said in a note. Some on Wall Street aren't getting carried away, warning that there's still a long way to go for inflation to return to the Federal Reserve's 2% target. Again, why do we have to have 2% inflation? Shouldn't things get cheaper every year? Quote, while today's report is encouraging, the Fed is a long way from claiming victory and will have to remain in inflation fighting mode, end quote, Jeffrey said in a note. U.S. Treasury yields took a breather following the data, briefly helping growth sectors of the market, including tech, catch a bid. Energy stocks were the biggest gainers in the wake of surging oil prices as global demand worries eased after Shanghai curbed some of its COVID-19 restrictions. Marathon Oil, Devon Energy, Diamondback Energy led the gains in the energy sector. Losses in consumer discretionary stocks were limited by rising restaurant stocks after Citi highlighted Chipotle Mexican Grill, Darden Restaurants, and Texas Roadhouse as opportunities with the most upside that can ride out the waning reopening boost and the impact of labor shortages. CarMax fell more than 9% after reporting mixed quarterly results as earnings fell short of estimates on declining sales volumes. Bank stock struggled a day ahead of JP Morgan quarterly results as falling treasury yields weighed. In other news, PG&E rose 3% after it agreed to pay a $55 million settlement over two fires in Northern California. Sentiment was also hurt by fading hopes of the Russia-Ukraine ceasefire as both sides prepare for an intense battle in the eastern Ukraine region of Donbass. Russian President Vladimir Putin said with Ukraine, quote, have again returned to a dead-end situation for us, end quote, after Moscow was accused of committing war crimes in Bucha. How come no one ever accuses the United States of war crimes? I mean, they've invaded half a dozen countries just since I left the Navy in 1997. So I don't see anyone pointing fingers at them. Oh, wait, they have all the money and all the military. Yeah, that's why. All right. Next article, it has to do with inflation. U.S. consumer prices surge on gasoline. Inflation likely peaked. I don't know about that, folks. U.S. monthly consumer prices increased by the most in 16 and a half years in March as Russia's war against Ukraine boosted the cost of gasoline to record highs, cementing the case for a 50 basis point interest rate hike from the Federal Reserve next month. The acceleration in prices reported by the Labor Department on Tuesday culminated in annual inflation rising at its fastest pace since the end of 1981. But there's a cautious hope that most of the worst of the post-pandemic inflation surge is behind. Monthly underlying inflation pressures moderated as goods prices, including food and energy, dropped by the most in 2 years. Further declines in so-called core goods prices are likely as demand shifts back to services amid the rolling back of COVID-19 restrictions on businesses. Quote, the Fed will take a tiny bit of comfort from today's report, but it still has much work to do to restore price stability, end quote, said Sal Gutierrez, a senior economist at BMO Capital Markets in Toronto. The consumer price index jumped 1.2% last month, the biggest monthly gain since September of 2005. The CPI advanced 0.8% in February and an 18.3% surge in gasoline prices, the largest since June of 2009, accounted for more than half the increase in the CPI. Gasoline prices at the pump, on average, soared to an all-time high of $4.33 per gallon in March, according to AAA. Inflation was already a headache before Moscow's invasion of Ukraine, which unleashed a barrage of sanctions, including the banning of Russian oil imports by the United States. See, they said it right there. Inflation was a problem prior to the Putin price hike. Every time that redheaded dumbass says that on TV, I just want to slap her. Americans are not the only ones reeling from high inflation, which was initially fueled by huge amounts of money doled out by governments across the globe to cushion against the devastating impact of the coronavirus pandemic. Yeah, that cold was nasty. The Russia-Ukraine war, now in its second month, has led to a global surge in food prices as the two nations are also are major exporters of commodities like wheat and sunflower oil. Quote, if not for Russian President Vladimir Putin's imperialist ambitions, inflation would still have accelerated this month, though not nearly as much, end quote, said Chris Lowe, chief economist at FHN Financial in New York. Inflation also increased broadly last month, with food prices rising 1%. The cost of food consumed at home climbed 1.5%, as all grocery categories posted big gains. Groceries increased 10% on a year-on-year basis, the most in 41 years. But the cost of dining out grew less, with prices for consumed food away from home rising just 0.3%, the smallest gain in a year. In the 12 months through March, the CPI accelerated 8.5%, the largest year-on-year gain since December of 81. After a 7.9% jump in February, it was the sixth straight month of annual CPI readings north of 6%. Last month's increase in inflation was in line with economists' expectations. Stocks on Wall Street were higher, the dollar was steady against a basket of currencies, and the U.S. Treasury yields fell. Monthly core CPI slows. The strong CPI readings followed on the heels of news last month that unemployment rate fell to a new 2-year low of 3.6% in March. The U.S. Central Bank in March raised its policy interest rate by 25 basis points in the first hike in more than 3 years. Minutes of the policy meeting published last Wednesday appeared to set the stage for a big rate increase down the road. The Fed is expected to soon begin trimming its asset portfolio. High inflation and the Fed's hawkish posture have left the bond market fearing the U.S. recession, though most economists expect the expansion will continue. Excuse me. Many believe March could mark the peak in the annual CPI rate, but caution that inflation would remain well above the Fed's 2% target at least through 2023. So that's a year from now, or a year and a half. Gasoline prices have retreated from record highs, and last year's high inflation readings will also start falling from the CPI calculation. There's also a sense that consumers confronted with declining purchasing power are becoming more price conscious, which could make it harder for businesses to pass on higher prices. Inflation adjusted weekly earnings fell 1.1% in March. A second straight monthly decline in prices of used cars and trucks restrained the core CPI to 0.3% rise after increasing 0.5% in February. Core goods fell 0.4%, the biggest drop since April of 2020. That blunted part of the 0.5% gain in shelter costs, which accounted for nearly 2/3 of the rise in core CPI. With a key measure of rents, owners' equivalent rent of primary residence advanced, the pace slowed a bit to 0.43% from 0.45% in February. The core CPI rose 6.5% in the 12 months through March, the largest gain since August of '82, after advancing 6.4% in February. Though demand for goods is cooling, increased appetite for services will keep inflation simmering. Further disruptions to supply chains from Russia-Ukraine war and lockdowns in China contain a resurgence in COVID-19 infections are also seen, keeping prices for some goods elevated. Workers squeezed by inflation are demanding large wage increases. Prices for hotel and motel accommodations increased strongly last month. Airline fares soared 10.7%. Household furnishings also cost more, as did motor vehicle insurance, apparel, recreation, and personal care. The cost of healthcare rose 0.5%, with both doctor visits and hospital services increasing solidly. But prescription medication prices fell 0.2%. Woohoo! Quote, we expect demand for goods to waver as spending pivots back toward services, and this transition should temper goods inflation, end quote, said Michael Pugliese, an economist at Wells Fargo in New York. Quote, pent-up demand for travel should lead to a few more months of solid gains for airfare and lodging prices, but there will likely be less scope for catch-up come autumn. All right, so that's a lot of information there. So things are just getting more expensive. How do you feel about that, Jake? Yeah, I thought so. He's back there in the corner over my shoulder. All right. Next article has to do with the dollar. Dollar rebounds as Brainard assures markets Fed will stay the course. We will see. The dollar rebounded on Tuesday after digesting slightly softer than expected U.S. inflation data, while the euro extended losses ahead of a policy-setting meeting at the European Central Bank. Federal Reserve Governor Lael Brainard said Tuesday that there were some signs of, quote, welcome cooling in the latest inflation readout, but emphasized that the central bank is still proceeding with a series of interest rate hikes as well as an effort to trim its balance sheet. Quote, I'll be looking to see whether we continue to see moderation in the months ahead, end quote, Brainard told the Wall Street Journal in an interview, referring to inflation in the core goods category. The U.S. Consumer Price Index, yeah, we already got all that stuff. Brainard's comments highlighted that the Fed, quote, is not pivoting at this point, providing an assurance for the greenback after a morning of choppy trading, said Bipen Rai, head of FX trading at CIBC. Quote, the path of least resistance is still for tighter policy and for an aggressive unwind of the balance sheet. And as a result of that, I think the dollar is stabilizing a little bit, end quote, he said. The dollar index rose 0.26%, with the euro down 0.51% to $1.08 per euro. Benchmark 10-year U.S. Treasury yields eased to 2.727 after reaching 2.793 on Monday, the highest since January of 2019. Inflation numbers initially suggested the Fed might not be as aggressive in the second half of the year as some had originally expected, said Edward Moya, senior analyst or market analyst at Owanda. Quote, while this doesn't change anything that the Fed will do over the next couple of meetings, it does support the idea that they won't be as aggressive with tightening policy later on in the year. And that's why we saw the dollar drop somewhat following the initial reaction, end quote, said Moya. The euro declined Tuesday as markets shifted their attention to the ECB policy meeting due later this week, with money markets pricing in about 70 basis points of interest rate tightening by December. Quote, the big focus for the ECB this week is whether or not the timeline to remove accommodative policy settings has shrunk, given the fact that the chorus of voices on the governing council have become more hawkish, end quote, said Rai. Investors will likely look for an indication that the ECB will wind down its asset purchasing program, which could tee up a rate hike in September, Rai said. Still, any rebounds in the euro will likely be limited due to the Russia war against Ukraine, said Moya. In addition to pushing up gasoline prices, the war, now in its second month, has led to a global surge in food prices as Russia and Ukraine are major exporters of commodities. Yeah, we know that. Quote, there's just this overall belief that until you have a resolution with the war in Ukraine, their economic outlook is really going to be a big question mark, and that's not necessarily going to be good news for flows for the euro. Yeah. So it appears that the Fed is going to stick with their mission to get rates up as high as possible to squash the inflation that we're seeing. Again, my fear is that as soon as we have a bump in the economy or some sort of a recession in the stock market, that everyone's going to panic and that they're just going to drop rates back to zero, and we're going to be right back in the same situation a year from now. I mean, if the republic lasts that long. So my personal hope is that the republic collapses and we're all freed from having to give up a third of our salary to the federal government. That's my hope. All right. One last article has to do with what you can do with your money with all this inflation. As inflation hits a new 40-year high, 5 financial advisors on what they're doing with their own money amid high inflation. Let's see. And I'm not going to read through all this, just going to hit the highlights. So for this first person, Leslie Thompson, Chief Investment Officer at Spectrum Wealth Management. They like dividend growth stocks from quality companies. And here's a reason: to combat the effects of inflation on my future purchasing power, I invest in dividend growth stocks focusing on quality companies with a competitive brand positioning, solid balance sheet, and cash flow and earnings growth, which is different from investing in a stock with the highest yield. Definitely good advice there. Quality equities is probably the way to go heading into this next cycle of the market, because unfortunately, when you go through downturns, the companies that are not in good shape are typically the ones that go out of business. The ones that have strong balance sheets, good cash flows, their profit and loss looks good. Those are the ones that are going to survive it. And, if they pay dividends, even better. Next, from Andrew Ross, private wealth advisor at Integrated Partners. He likes stocks and real estate. I have a long time horizon, so I primarily invest in stocks to combat inflation. If given enough time, stocks have historically outpaced inflation by a wide margin. I also believe that real estate is a critical part of a well-diversified portfolio, and it's also a great inflation fighter. My primary residence has increased in value, and my rental property has not only increased in value, but our rental income has been increasing every year, every 2 or 3 years. So again, hard assets, gold, silver, property, oil, things that have, tangible value, probably not a bad place to stick your money. Agricultural, this next person is Tatiana Soir, certified public accountant and author of Dream Bold from Start Smart. They like agricultural investments and real estate. Real estate is a good investment during inflation. And let's see. Let's see here. Skyrocketing gas prices, along with inflation, have made us think about about farmland acquisition and other agricultural investments. So again, things that you can put your hands in the dirt. Next person, Kyle McBrien, certified financial planner at Betterment. They like a diversified stock portfolio and very short-term cash. And his rationale: for the money I need in the next few months, I'm keeping it in cash because I know roughly how much I need and when I need it. Yes, it's possible I may lose some purchasing power to inflation, but the alternative choice is to invest funds to keep up with inflation. In that alternative, I risk losing money to market volatility, which we have seen plenty of lately. And lastly, Mitchell Connell, chartered financial analyst and president of Portia Capital Management, likes private debt and luxury watches. To avoid further inflation and interest rate risk, I sold my bonds with maturities of 3 years or more. And then also, luxury watches have increased over 60% in the past decade, and that trend is expected to continue as luxury watches are seen as a means of storing wealth. So again, instead of gold and silver coins, maybe go out and pick yourself up a nice Rolex or a Tag. I know I've had a Tag Heuer watch for, gosh, I guess I bought that back in 97, 6. It was right after I got married. So it was, I think I paid $1,500 for it. I imagine it's probably still worth at least that, if not more. It's an expensive watch, and you got to take care of it. You got to send it off to have it serviced every few years to have the battery replaced. But hey, it's taken a beating over the 20 plus years I've had. Well, gosh, almost 25 years I've had it. So, it's keeps a licking and keeps on ticking. So, all right. Well, you didn't come here to hear about my watch purchases, but again, those are some good ideas as far as maybe where to put some of your shorter term cash that you're not necessarily investing in the long term market. Tangible assets are always good. Gold and silver pieces sometimes are a good idea. But you want to have you want to keep your money in places that it's not going to lose its value too quickly. But at the same time, you want to keep enough cash in place, in your bank and savings accounts, to get through 90 days or 6 months of the unexpected. So. All right. Well, that's everything I had for today. I hope everyone has a fantastic evening, and I'll be back tomorrow with Wednesday's Liberty Call on Hump Day. And so if anyone needs anything from me, if you have a question, comment, you want to book a meeting, go to dsafinancialgroup.com. All my contact information's there, and I'll be back tomorrow. So everyone have a great night. Bye-bye.